Welcome to this explainer. The modern financial system is basically a massive multiplayer video game, and for most of us, it feels entirely rigged against us. But honestly, that's only because nobody ever handed us the instruction manual. Well, today, we're cracking open that manual to learn the actual rules of money, and I'm going to give you the exact cheat codes you need to rig the system right back. Okay, so picture this. You've just had a grueling month slaving away, flipping burgers, working crazy shifts. You finally get that sweet notification saying you've been paid $2,000. You check your bank account, fully expecting to feel rich, but instead you stare at this shockingly lower number, $1,456. I mean, where on earth did the rest of it go?
Well, those missing funds were snatched up by invisible forces we call taxes. It's basically the modern ritual of giving away your hard-earned money and being expected to say thank you for it. But here's the deal. Taxes are really just the cost of civilization. They build our roads, they fund our schools, and they make sure your favorite late-night taco truck isn't infested with rats. You've got income tax on what you make, sales tax on what you spend, and capital gains on the money your investments make while you sleep. Then there's Social Security, which is essentially the government forcing you to save for retirement, and Medicare to help out the sick and elderly. But you know what the absolute craziest part is? When it comes time to file, the government already knows exactly what you owe, but they make it this dangerous guessing game. And if you guess wrong, yeah, you're cooked.
All right, let's move on. Section title, The Vault is a Lie. Subtitle, Shattering the Bank Myth.
So after the government takes its cut, you put whatever is left in the bank. You hand the teller your money, and you probably imagine it sitting in a giant steel vault guarded by a dragon, right? But the reality? Your money is already gone. Banks aren't vaults, they're financial middlemen. They are basically just matchmakers.
It's this brilliant little system called fractional reserve banking. Say you deposit $1,000. The bank keeps a tiny fraction of that on hand, say $100, and they immediately lend the other $900 out to a guy down the street who wants to buy a jet ski. The whole shebang relies entirely on the assumption that everyone won't show up at the exact same time to ask for their money back. Unless it's 2008, of course, when the entire system basically crumbled, because that's exactly what happened.
But hey, don't panic. Despite how crazy this system sounds, your money is actually way safer in a bank than stuffed inside a shoebox under your bed. The U.S. government steps in and insures your deposits up to $250,000. So no matter what happens to that guy and his jet ski, the government ensures your money is totally safe.
Next up, our section title, Invisible Money Drainers. Subtitle, Interest and Inflation.
So let's say you borrow $1,000 but have to pay back $1,280. Why? Interest. Interest is simply money's way of charging rent just to exist in someone else's hands. If you miss a 20% credit card payment, that interest starts earning its own interest, and suddenly your $12 late-night burrito turns into a $50 financial regret.
Understanding how this mechanism works, whether it's working for or against you, is absolutely crucial. Simple interest is basically just a flat fee for playing the game. But compound interest? Oh man, that is your dollars actively cloning themselves, and then those clones go out and earn even more rent. So while compound debt is this slow burn that completely destroys you, compound investing at around 7% is a literal cheat code. It duplicates your money over time so you can wake up one day, old, rich, and just a little bit smug about the whole thing.
But listen. There's another silent thief out there you need to watch out for. Ask yourself, why did that $500 TV suddenly become $800? You didn't get poorer overnight, but your money quietly got less valuable. That, my friends, is inflation.
Inflation is this slow, quiet erosion of your buying power, and it's generally driven by three main things. Sometimes there's just way too much cash flying around. Like 2,000 people want to buy the TV, but there are only 1,000 TVs in existence, so the business just jacks up the price. Then, sometimes it's supply chain hiccups, making things way more expensive to actually build, and sometimes it's just human expectations creating this wild, self-fulfilling prophecy where people spend fast before prices rise. Now, to put things into perspective, a predictable 2% inflation is totally normal. But when it spikes, the government has to step in and raise interest rates just to cool off the spending party.
Moving right along. Section title, Financial Storms and Trust Scores. Subtitle, Surviving the System Resets.
Kind of think of the whole economy as this massive party. Over in month one, during the boom phase, the drinks are flowing, everyone's dancing, jobs are everywhere. But eventually, we hit the peak. The lights kind of flicker. By month 24, reality hits hard. We enter the bust. The DJ switches to playing sad lo-fi beats about corporate downsizing. This right here is a recession. At least 6 straight months of economic decrease. It's super painful for sure, but it leads directly to the reset. Governments lower rates, they send out stimulus, and eventually the party rebuilds itself. Recessions aren't forever, they're just painful but completely temporary resets to the system.
But while the economy is going through its macro resets, banks are quietly judging you on a micro level through a shadowy algorithm called your credit score. It's this weird 3-digit number that proves one single thing: trust. Will you actually pay them back? If you're dropping below 580, to them, you are a walking red flag. Lenders will either flat out deny you or slap you with a soul-crushing 27% interest rate. But hit over 750, you are radiating sparkling adult credibility.
To build up that credibility, you've got to follow some basic rules. Do you pay your bills on time? How much of your available credit limit are you actually using? How long have you had your accounts open? Honestly, think of your credit score like a pet dog. If you totally ignore it, it is going to poop all over your life. But if you take care of it, feed it with good payment history, and manage your credit utilization, well, someday it might just help you buy a house.
All right, section title, The Illusion of Currency. Subtitle, Value is a Construct.
Now, things are about to get really interesting, because underneath all these rules, credit scores, and banks is a truly shocking truth. Money itself isn't actually real. Seriously, what is the fundamental difference in legitimacy between a dollar bill and a random stick from your front yard? Physically, very little. The only reason a dollar bill buys something and a stick doesn't is because we as an entire society have collectively agreed to trust the dollar. Currency is just a social construct built entirely on shared belief.
It all boils down to perceived value. Take gold, for instance. It's literally just a shiny yellow rock. It's not inherently better than any other rock you'd find outside. We just value it more because it happens to be rare. It's the exact same reason Steve Jobs could get millions of people to hand over thousands of dollars for a shiny new iPhone, or why Gucci can sell a handbag for 100 times the price of the exact same bag sitting on a shelf at Target. They generated massive perceived value. So here's the secret. If you can figure out how to provide value, you are going to earn a lot of money in this game.
Moving to our final climax. Section title, The Ultimate Wealth Cheat Code. Subtitle, Investing and Time. Okay, beating inflation and truly winning the financial game comes entirely down to making your money work for you. I'm going to fire off these investment vehicles super fast for you. First up, stocks. Instead of just trading your precious time for money, you are buying a tiny slice of an actual company. If that company grows and provides more value to the world, your little slice becomes much more valuable too.
Next up, bonds. This is a much safer play. You are basically stepping into the shoes of the bank itself. You loan your money out to a company or a government, and they agree to pay you back with interest. You become the one collecting the rent on your money.
Then we have funds. Now, if you don't want to try and guess which individual company is going to win out, you buy a fund. It's this massive collection of stocks and bonds bundled up together. It's perfect for players who want to be diversified and patient without guessing game stress.
Finally, real estate. You buy a property and you basically hope someone else pays rent to live in it forever, covering your costs while the asset itself appreciates in value. Now yes, obviously all these investments come with some risk. Markets are going to go up and down. But you know what? The real danger isn't a market dip. The real, absolute danger is watching inflation quietly steal your future away just because you didn't invest at all. Because at the end of the day, the absolute greatest multiplier in this entire game is not luck. And it's definitely not a massive salary. It is time. Wealth isn't built in days, it is built in decades. Consistently investing a little bit of money over a long period allows that compound interest cheat code we talked about to do its incredible magic. So I want to leave you with one final thought. Now that you actually know the cheat codes,